So we got to the environment where good news for the economy is bad news for the stock market. And very good news for the economy is, guess what? A real dire to this giving and taking stock machine. Today I will walk you through the matter of all upside surprises. Today's report of non-farm payrolls was absolutely the one of an outstanding and I will walk you through also the other arcanes of stock market investing and the charts that right now are giving us a hope for a soft landing, but underneath bringing a more dire outlook. That's the Wall Street Station channel, the channel dedicated updating you with the most important revelations on the stock market, crypto, commodities. So if you want to join the great journey of investment, don't hesitate to subscribe to the channel. And we are right now moving to next element, that is the answer to the question, what might be the reverberations of this job market outlook on the stock market. So right now let's jump to what's on with job market. And after today's revelations, monthly job creation in the US just reached 336k. So it means it have beaten the assessments of analysts and bringing them to grind with the teeth after those pesky type of a trial of forecasting what the job market may bring. So employment expansion in September surpassed projections, revealing the resilience of the US economy despite increased interest rates. So it bringing the more likely excessively optimistic overview for what may come next. But there are some things that right now are opposing that very rosy outlook. Even though the payrolls increase was the best monthly number since January, right now we are at the beginning of something worse to happen that was going with the bonds market, but about it in a moment. So the US labor market continues to exhibit amazing strength with the number of new jobs created last month nearly twice as large as expected. But the labor market is at the end of this recessionary chain, the chain that giving us a real alert of what may come next. And if we just have a look at what's inside of it, we'll find out that the things are not that obvious for now. So right now, let's get to the elements of year-over-year non-farm payrolls bringing the outlook for average hourly earnings. And right here you can find that in the US the average hourly earnings is dropping, so it means it may weigh eventually on those savings rate of US households. So right now, even though we are moving up with some gauges according to expectations on where this inflation may eventually end up, so it means that this level of 2 or 3%, but even though its outlook for achieving that goal is so postponed, right now we are having some troubles with job market that right now is not reflecting that interest rates higher for longer. And even though that average hourly earnings is dropping, it still doesn't give us a right tip whether the economy is cooling down. We need the economy to cool down in order to stave off this inflationary momentum that already had taken place. Therefore, the job market is appointing some resiliency, but the bond market finding it in a longer time horizon very worrisome. especially that this sell-off of bonds is right now in its driver's seat, and the longer they are sold off, the higher possible perturbances may eventually become. So right now there are very, very obvious questions of whether this landing of the economy will be a soft or rather hard, and this narrative has been returned to us right after this bond vigilantes took its driver's seat. So higher interest rates raise the cost of capital and run counter to the easy monetary policy that has been underpinned Wall Street strength for much of the past couple of, it was 14 years since 2009. Right now, let's jump to another finding, a calm before the storm. So we can find that the major issue with pre-recession data is significant revisions, and that was also observed back in 2007-2008. We had claims, initial jobless claims, rising before a recession took place. So it's another very dire and discrepancy type of a news. And there is a headline out of the newspaper being published on January 26th of January 2008, just before the Great Recession. Fall in new jobless benefits claims shows labor strength. So can we cheer right now out of the very strong rebound in non-farm payrolls? I would say so, but at least for a while, and one swallow doesn't make summer, obviously. Right now, let's look at the broader outlook of the job market, factors contributing to the labor crisis, bringing the baby boomer retirement, low birth rates, shifting immigration policies, changing worker preferences. So there are many things that are weighing on those skewed to the downside type of outlook for initial jobless claims and job market as a whole. So even though in a short and medium term time horizon we are recovering, the overall trend is somewhat worsening. So the implications also may include eventually slower GDP growth, reduced productivity, and constraints on business expansion. So it's alarming to see those gauges being so deteriorated. And what's the runway to thrive? Among those, there's increased labor force, boost productivity, and immigration. But those are the things that may eventually be recovered in the years to come, not the months. So this possible recession may not be saved. Right now, let's point out the greatest worrisome of the current market. That's the bear steepener. So the yield curve disinverts before a recession. That's the finding that was working out in the previous downturns. Sorry, this lines has overlaps each other after export. So sorry if it doesn't visually works very fine, but regardless, I will try to get the point of what have just have been attached. So there was a great finding, the quote, the most important question at this point is not whether an additional rate increase is needed this year or not, but rather how long we will need to hold rates at a sufficiently restrictive level to achieve our goals. That's what one of the Fed's members said. So given that this steepening is an anomaly, right now we can find that the bond market is assessing that this higher for longer will stay with us for a while, and that's no way to say that it may cause a ripple effect on what may come next, as this tightening of lending standards may weigh on many of stocks, not only those small and medium cap, but also even in the longer term on seven magnificent companies out of the this behemoths pushing the indexes higher. Right now, let's jump to hiking cycle, and the investors foresee the end of tightening cycle. But what about bond market? Bond market is right now the one of the of being privileged, as they had in the history the right voice more times than the market was. So I do rather stand for what the bonds market is saying, and the bonds market right now is not foreseeing such a phenomenon, and the bonds are afraid of having those interest rates being risen even up to 7%, as Jamie Dimon says. So the situation right now is very challenging for both bonds and stocks, even if the upcoming data out of the economy may eventually improve. This situation we have found that is not revertible before the hard landing take place. That's what the bonds market is saying. So the outlook is becoming more restrictive and more difficult for more and more entities, especially with this M2 money supply. That's a measure of money supply that includes cash, checking deposits, saving accounts, money market securities, bringing us to a lower level than it was back during latest over 90. So it resembles obviously 2008, but even for this we can observe that M2 yearly growth was the one that was with a striking resemblance to where we were back in 1930s. So that's obviously one thing that's giving us a real head scratcher, and the resemblance are kind of pertinent due to what we can observe and what has happened in the past. So it may also cause some more reverberations. So the growth of M2 money is right now at a negative point, which is 5% worse than during the GFC, and that's the also element that we cannot really get unstopped. Market seeking for liquidity. So if we just have a look at where the market may be going, for this one, I want you to send to the more interactive type of website, that's TradingView, and SPX right now is trying to rebound out of this local bottom that it had been found at, and on RSI we can find that we are reaching almost on the 4-hour chart almost 50 points, but right from here on a daily and weekly, in order to rescue the current trajectory, we will need to bring a closing head of this hammer a bit skewed to the upside. At best, it will close right at the top of this week at 4,300. Otherwise, I would still stay bearish. So for now, if you just have a look at SPX, there is a try of the real attempt to move ahead this levels below this upper week. So without this, the chance for bulls to return to the game is right now, I would say, extinguished. And if we just have a look at US 100, for here, it's a little bit more optimistic. So it looks like we may be up to revert this head and shoulders formation by both sides. That right now possibly risking the situation. But I do find that for this one, as I said, that the good news for the market and very good news for the market right now may be the one thing that may eventually push Federal Reserve to bring this interest rate hikes even higher. Therefore, I'm not really popping the champagne and just waiting for close of the day on the markets. And I'm just would rather say that we'll eventually close negative in the next week, but we'll just have to see yet. For me, this US 100 is showing some strength, and that would be unreasonable to bet against it. But you may just pop it in a chat. What's your stance on those major indexes, whether you're buying or selling right now? I'm very curious, as right now the point we have just found out is kind of quizzical. All right, so we are jumping back to our presentation. That's what I said. Jamie Dimon emphasizes the readiness for potential 7% interest rates, citing uncertainties. He acknowledges uncertainty regarding, for instance, scenarios of hard landing. Such high rates could adversely affect consumer spending, business investment, and economic growth. That doesn't put upward pressure on stock valuations, and that's what the market is afraid right now. That's why I do find that this concern may be staying with us for longer. But as we do know, we are right now in October, statistically a positive month for the stocks. Therefore, it's yet to be told how eventually it will end up. You have to be open-minded, of course. Final thoughts and Q&A. If you have any burning question, just don't hesitate to pop it right now. Otherwise, pop it in the comment section below the video right after this live will end up. So inverted yield curve may stay as such for many months before recession. So even though we have inverted the yield curve back in 2006, it also been inverted, and we had to just wait over 2 years for the scenario of recession to materialize. The concern about higher for longer is a dominant narrative on the market that is pushing valuations lower. That's my stance I'm holding up to, and let me know what do you think about the stock market right now? Going up or down? That's the question for the weekend. Thank you very much for watching. Have a great Saturday and Sunday, and just take a rest. All right? So we are getting back on Monday at 8 a.m. ET time.